If you are a trader, investor, most likely you've heard of correlation. And if you didn't, then you are at the right spot to learn about correlation. In the financial markets, correlation refers to a statistical number that measures the degree at which two securities move in relation to each other. That is a lot of words to describe really simple relation. So if you have two securities, these could be anything. Let's take, for example, Microsoft and the S&P 500. If they move together, that means they are positively correlated. And if they move opposite to each other, that means they are negatively correlated. Again, this refers to any two securities. You can take the Euro USD with the British Pound Japanese Yen. You can take the gold versus crude oil. So any two securities, you can measure their movement in relation to each other. Now, this can be calculated using some math, but of course, nowadays, most trading platform, you can do it. Also, I'll teach you how to do it in Excel really easy. First, let's see some examples of how correlation looks like in reality. So here I plotted 5 instruments: the British Pound USD dollar, the Euro USD dollar, British Pound Japanese Yen, US dollar, Canadian dollar, and gold. And just from a glance at this chart, we can see from this glance that the yellow line, which is the British Pound Japanese Yen, move almost in sync with Euro US dollar and British Pound US dollar, and move opposite to US dollar Canadian dollar. Also, it looks like gold moves opposite against the British Pound Japanese Yen. Of course, when you are trading, you cannot depend on looking at the chart and figuring out if it's correlated or not. So you need to calculate this number to find out exactly. So before we calculate the number, why this is important? I mean, if this is an indicator, I have a million indicators that I can plot. So what's the purpose of finding the correlation of an instrument? So if you are following my advice, which I always say, to trade a portfolio. Trading a portfolio, limiting down your risk and increasing your probability of making money, because you'll have multiple strategies, multiple instruments. They are each having different return stream. So you smooth out your equity curve going up while you reduce your drawdown. So if you're following that advice and trading a portfolio, so you don't want to trade correlated instruments in that portfolio. Let's say the Euro US dollar is highly correlated with British Pound US dollar, which they are. So if you trade both of those instruments in the same portfolio, they move together. So theoretically, if you go long on both instruments, it's like double down on the same position. It's like you're trading Euro US dollar double the size, or British Pound US dollar double the size. And if you trade the Euro US dollar with the US dollar Canadian dollar in the same portfolio, these two instruments are negatively correlated. So theoretically, if you go long both of them, it's like doing nothing, because now this currency going up while the other currency going down. So one will lose, one will make money. So it's like hedging, but you're not gonna make money unless like the difference is big between them. So that's the number one reason why we want to know correlation, because we want to diversify the portfolio that we are trading. So we don't want highly correlated instruments, positive or negative. Now, what is negative? So if we are comparing two instruments, one always goes up while the other one goes down, that means they are negatively correlated. And also we don't want that. We are looking basically for no correlation. The less correlation, the better it is. So how do we measure correlation? We measure correlation on a scale from -1 to 1. This could be also -100 to 100. If you are at 0 level, that means there is no correlation. That means when one instrument going up, the other one is doing nothing, moving sideways. And when one instrument going down, the other instrument also doing nothing. Basically, they don't move together at all. And here are the levels I put in. So 0 is no correlation, and that's what we are looking for always. So 40% or 0.4, that's considered a weak positive correlation. if you are reaching 70% correlation, that means this is moderate positive correlation. So you can depend on something like this. And of course, if you go higher, like 90, this is highly positive correlation. And of course, 100%, this is perfect correlation. You can't find this on long term, but it could happen on daily correlation. Of course, the other side is the negative side. So minus 40 weak negative correlation, minus 90 is high negative correlation. Now, correlation is not a fixed number. You can measure correlation over any period of time, over 1 day, over 15 minutes, over 1 month, 1 year, 10 years. Regardless of the period you will pick, you will see that correlation goes up and down during that period. It's impossible to have one fixed relation in correlation. So these are the correlation with multiple instruments compared to the Euro US dollar. So Euro US dollar in blue, and then all these are futures instrument, some of them commodities, indexes, and then here we have the currencies. Now, just to let you know that in Excel, you just put the close prices, and then there's a simple command called correlation. So it's shortened to CORREL. And then you just put the data. So, for example, here I'm comparing the Euro US dollar with the British pound. So you just put the data in and that's it. It calculates everything for you. So we can see that the Euro US dollar highly correlated with British pound US dollar and with the Canadian US dollar. Then it's moderately correlated with the Japanese US dollar, then weak correlation with the Swiss franc US dollar, and then no correlation with the Australian dollar US dollar. And then if we compare with the indexes, these indexes of course are priced always in US dollar, so they will always be stable, negatively correlated to the euro dollar. And then we have these instruments that are priced in US dollar, so they will move opposite to the US dollar, and that's why they are positively correlated to the euro dollar. Now, the schedule that I just showed you is calculating the correlation over the past 17 years. So that's a long period of time, and it's also showing us one number. As I told you, correlation changes over time, so you need to see the rolling correlation over time. So these are the rolling correlation between the Euro US dollar and the British pound US dollar. And now this is over 17 years. So the green line is the yearly correlation, the orange line is the monthly correlation, and the blue line is the weekly correlation. And you can see how schizophrenic is that. Although we're spending most of the time positive, above zero, but a lot of times we dip below to a 90 level. So look at this one and this one. But when we go to monthly, we can see we have rare occasions where we dip below zero up to the level of 50. Most of them are below 50. And of course, on yearly correlation, we are never going below 40. Now we can dig deeper. So here is another chart. This chart now is for the past 2.5 years. So again, the green line is the yearly line, and we can see that the yearly line went above 60% in September of 2021. And since then, we are moving upwards. So the past year, the correlation are going up and up between the Euro USD and the British Pound USD. Also, these are the shocks in the market. So this is the COVID crisis, and we can see how the correlation went from positive 70 to negative 40. Now, it didn't stay long. So this, if I take a point here, this is March 5th all the way to March. So it's about 2 weeks where it dipped below zero and then it came back. Also here we have another swing down, and this time it's in February 2021. I don't know what happened there, but again we dipped for almost 2 weeks below zero and then we came back. And again, last one happened here in December of last year, where we dipped below zero for a couple of days and then we went back. So from the rolling correlation, we conclude that for short-term trading, really correlation, they don't matter as much because they swing up and down a lot, and you cannot depend on them. But if you're taking longer positions, say monthly positions, 3 weeks, 1 month, more than 1 month, then you need to look at correlation, because the average correlation on yearly basis, they are almost fixed. They go between very small range. And even when they change, when, let's say, for example, like we saw, when they dip and diverge away from the average correlation, they don't stay long. So for the monthly we saw in COVID, it's 2 weeks, and then it comes back to the average correlation. In fact, you can trade this correlation in a mean reversion strategy. Now, if you're trading short-term strategies, there are other ways to measure correlation over short-term period. So here I picked some sites for you that does this. So if you go to my FX book, you can take 5 minutes, 15, 30, 1 for 1 day, 1 week, and 1 month. So if I take, for example, over 1 month, so I'm sorting the highest correlation on the Euro USD with all these currency pairs. And let's see, so find currencies with correlation lower than or higher than. So if I find currency correlation higher than 80, that means this is highly correlated. So we can see that the Euro USD is highly correlated with Euro, Singapore dollar, Aussie dollar, Singapore dollar. Now this over the past month. If I switch this to 15 minutes, now we can see it changed a lot. So now I only have one currency pair, which is the British Pound USD, that it is highly correlated with the Euro USD. So you can use this data as a filter to your strategy. So here is another site, mataf.net, and this one plots a heat map, and this is daily, and you can go to 4 hours, hourly, 15 minutes, and 5 minutes. Let's look at another one. So this is British Pound Japanese Yen and Euro Japanese Yen. And now we can see on all time frames, we are above 70. So this is highly correlated on short time frame. From 5 minutes all the way to daily, we are highly correlated. The last site I'm going to show you is Baby Pips, which is a educational site. And here is the Euro USD correlation with these pairs over 1 week, 1 month, 3 months, 6 months, and 1 year. And you can see the disparity where this one is minus 0.23 over 1 week and minus 0.69 over 1 year. And for British Pound US dollar compared to the Aussie USD dollar, over 1 week is 0.94, and over 6 months it's almost 0. So to sum up, correlation is really important concept. You need to pay attention to it. What you want is zero correlation in the instruments you are trading or in the strategies you are trading in a portfolio. The priority is on the strategies, because you can trade different strategies on correlated instruments and they will yield to different returns. As always, if you have any questions or comments, please do so below the video and I'll be more than happy to answer you. I do read and answer all questions sent to the channel. And if you want to take this further, be a part of my inner circle, you are more than welcome to join the Discord server through the link below, where I host live weekly questions and answer sessions where I can answer questions in more detailed way other than the comments in the channel. And of course, all these questions are recorded on video and documented where you can search them in a database that is available for you. Also, we have now 3 portfolios with monthly signals trading in the Discord server. Don't forget, if you like this content, please do subscribe and hit the notification bell so you don't miss any of the future videos that I post on the channel. Also, it would be great if you can share the video with others, as this will help me grow this channel to reach more investors and more traders. And finally, good luck with your trading, good luck with your investing, stay safe, and I'll see you soon.